All right, everyone, welcome to our webinar here as we kind of start to let you all in. We're so glad you've joined us this late morning. I'm here with John and Caleb of the Kambs Jennings group here at Compass Mortgage. My name is Jessica Sims. I am on our marketing team here at Compass as well, and just want to welcome you all to our webinar today where we're going to talk about the top 3 things you can do to improve your credit. So we have our experts here, like I said, John and Caleb. So they're going to introduce themselves and then kind of take it away. We'll cover those 3 topics, and then at the end, we'll take all of your questions, okay? So with that, John and Caleb, go
Awesome.
ahead.
Thank you, Jessica. So yeah, we're the Kambs Jennings group of Compass Mortgage. We're an independent mortgage bank. We underwrite our loans in-house. We fund our loans. Got a really amazing team that would love to help you out. And whether you're a realtor joining us today to learn more information for your clients, or whether you're a future buyer, someone who's going to be looking to buy, we want to be a resource for you. So we're going to hit on these points today. And we're going to have some questions as well, but don't hesitate. Also hit us up. You can message us, email us, reach out to us. We'd be happy to talk to you. So I'm Caleb with the Kambs Jennings group.
And I'm John.
Yeah, so we're a team. We're located in Chicago, but we're licensed in many other states. So we're willing to help you out if you're outside of Chicago. We're here for you as well. So we wanted to hit on today just the fact is that as loan officers, we pull thousands of credit reports. And with that, we see the good, the bad, the ugly. We see it all. And from that, we see a lot of common themes, problems, issues that come up. And sometimes just simple things that could be addressed earlier that can really be a game changer for you when you're going to buy, or for if your client's going to buy. And the importance of this is that what your credit score is really is going to impact how much you're paying, and not necessarily for the purchase price, but in your interest rate, which could be thousands and thousands of dollars over the life of a loan. So without further ado, I think we'll just turn it over. I want to talk to John about it. Like, John, what is the number one thing that you would say folks should focus on to make sure that their credit is on track?
So intuitively, pay your bills. So, but the way that they utilize it, the first thing is if you look, you can actually Google this, and there's like 6 things, but we're going to go over the top 3. But it's history of paying debts back, and there's a lot of confusion as to what that is. And but that is going to be the first thing that's going to have the biggest impact on your credit score, and that really comes down to making the payments, never going over 30 days late on something. So if you can't afford to pay the whole thing off, make the minimum payment. I've seen tons of people make the mistake of, especially young, like, oh, I'll pay it off in the summer. Well, make the minimum payment until summer. Never, if you're struggling, do your best to make that payment, even if it's 20 days late. Okay, it's not going to have a 30-day late on your credit score. So history of paying debts back, and then I think, Caleb, you can kind of elaborate on how to like utilize the credit so that you're actually not just paying it off monthly.
Yeah, I mean, I think, and that history of paying debts on time, and one of the things we often see too, just kind of like a common error, is that someone will forget. You may have like a credit card that has a really low balance, and you forgot that you even used it or something, and then you have you'll get a notice saying that you didn't pay your bill on time, and it was like $25. So do an inventory of anything that you have credit that reports to credit bureaus, and make sure you don't forget about them, because sometimes it's the small one that you forgot about.
Yeah, we've seen that where, oh, I'm buying a home. I went to Kohl's. They offered me a great deal if I opened up a credit card, and they never sent me a statement. And the way the credit laws are is that they don't have to send you a statement, believe it or not. They can literally be like, well, you signed up for a credit card. The agreement is you pay us, and it's up to you to find out the statement. So just if you get new credit, and make sure you're on top of it, because at the end of the day, if you don't pay it and you're late trying to get it off, they don't have to take it off, and they don't have to send you a statement. So be diligent on new credit that you obtain, and make sure you make the payment, because nothing's worse than you missed a $25 payment and now your credit score is 50 points lower, which is what can happen.
That's right. And then on that too, so one, don't be late on your payments. That's just the big one that we see, and that can be simple. And then two is credit utilization ratio. And with that, the credit utilization, what do we mean by that? So if you have a credit card and the max balance is $1,000, and if you are at $700 on that, now you're at 70% credit utilization on that credit card. And really the sweet spot on credit utilization, again, we're not experts, like we're not credit repair specialists. Like we pull credit every day and we see the problems and we give advice to our clients on how to address them and simple things. And one of them on credit utilization, let's say that you have paid all your bills on time. So you're paying your debts on time is great. However, you're maxing out your credit cards, or sometimes we'll even see someone's like 20 bucks above their max on their credit card. That can dramatically impact your credit score as well in a negative way. And what's awesome about that, though, is that if you've been paying your debts on time, number one, this can be easily solved, the credit utilization. As soon as you start paying those down, and if you can get your credit utilization down below 30%, you will see your credit score jump up remarkably, and then ultimately getting you a better interest rate on a mortgage and saving you thousands of dollars on your home. So that's one. And then there can also be an underutilization. So it kind of goes back to, these are all connected, but I've also has had clients that are like, yep, I'm debt free. I paid everything off. And for some reason, their credit score is just a little lower than they expected it to be. And we looked at it, and it's like, well, they have credit cards. However, they're not using them. So there's a zero balance always. And what that means is it's getting reported as 0% utilization, which doesn't give you any positive reporting. So the trick is keep it down below 30. But if you can keep it at 1% utilization, if you're just using it, it will report positive for you. And that's really the sweet spot where you're going to really see your credit score go up. Does that make sense, John?
Yeah, and it goes back to kind of history of paying debts. Like they don't consider history of paying debts being like, oh, I put $1,000 on my credit card and I paid it off every month. That's not what they want to see is, oh, you put $500 on your credit card and you made minimum payments for 6 months and then you paid it off. And that what they really want to see is that you can manage the payments monthly. So it's kind of, nobody likes to pay interest, but at the same time, lenders like to see that you can pay interest and that you can manage the payments. So keep it in like the sweet spot. And then the other thing I would say too is that we often come across people who are like, oh, hey, I know that I'm overutilized on my credit. Go ahead and pull my credit report and I'm going to go pay everything off. The great news is it is a quick fix. If you have 30-day lates and multiple delinquencies, that's not necessarily a quick fix. It's going to be a year, 2 years of you paying on time. Credit utilization is a quick fix. You got to pay it off. However, if you know you're going to buy in the next 6 months and you're going to call us in 3 months, get them below 30% before you call us, because what's going to happen, what we see often is it's like, okay, we pull credit. Now you're going to go pay it off. Now we've got to wait for it to update. Now you're scrambling because you want to close in 30 days, but you want the higher credit score. So we definitely recommend getting below that 30% before you call us if you can. And it'll potentially save you some stress as you're coming to the finish line.
That's right. And the other point, so just to kind of recap, one, don't be late. You know, the history of paying your debts on time matters. Two, your credit utilization ratio, how you're utilizing your credit, keep it below 30%, but use it so it reports positive. And then three, what we look at is the length of credit history you have. So John, what do we mean by that? What's my length of credit history?
Yeah, so they like to see not like, oh, I have 3 credit cards that I opened in the last 6 months and I haven't, I've made payments on them, but it's only been 6 months. So the sooner you can start establishing credit and paying it on time and making minimum payments, the longer your history is, the better. So that's pretty much what it is. So again, the sooner you can start getting credit that is established and have a longer history, there's a saying that no credit is worse than bad credit, and you can actually argue it is. Like somebody with lower credit scores but that has credit can get done, where somebody who has no credit score, like we pull their bureau and it says no history, those are much harder to get done than somebody with poor credit. So
And I'll
start
say,
early and start often, I guess the best way.
and a common pitfall that we see with this is that we'll pull a credit report and we'll see, wow, they closed this account. So the client may have had a credit card from 10 years ago, and then they decided, I don't really use that credit card anymore. Or maybe they hate the credit card company and they close the account. And what's unfortunate is that they shut off that history. So our advice to you is, if you have a credit card and if you don't really use it, but you've had it for several years, keep it, because it's reporting a credit history for you as well. Utilize it just a little bit, and it will then maintain that history for you. So don't just shut off a card, close out a card, just because you think you don't need it, you don't want it, or what have you. Make sure you think about it, because it really can be a positive impact to your credit score, showing that you have had a credit history.
Especially during the process. We've had clients who,
yes.
Like, oh, I'm going to go pay off my 3 credit cards and close them. And then it's like, okay, well, depending on the loan, there may be trade line requirements, and they may say, oh, well, we want 2 or 3 trade lines reporting for 12 months. Well, you had them, but you just closed them and now you don't. So
we're going to open it up for questions here shortly. Just to recap though, one, don't be late. It really matters. The history of paying your debts on time matter. Don't get caught like with any unexpected payments that you didn't realize you had, like silly $25 payments. Just make sure you really are mindful of your bills and pay them on time. Just don't be 30 days late.
And one thing we see all the time, cable. I moved, I had cable, now I've got Comcast reporting me as late. Utility bills, when you move, they'll report it and it can negatively impact your credit. Medical bills, like medical collections, pay attention to your mail.
Yep, absolutely. So then there's credit utilization. Just again, make sure that you keep your ratios as low as possible, but do utilize your credit so it reports. And then 3, length of credit history. So I wanted to go back to Jessica to see if there's any questions for folks that have come in, or we want to open it up for questions.
Yeah, thanks, guys. So we do have some questions here. So I'll start first with, you mentioned a sweet spot with credit utilization. Can you identify that more in terms of a percentage? You did mention, it's better to be under 30%. Is there more of a sweet spot that you can identify? Do you want to be at half of that? Could you just touch on that a little bit?
Yeah, I mean, so again, I do. The caveat is we are credit repair experts and things like that, right? We just see credit reports and we give advice based on that. If something is too challenging, we'll refer it to a credit repair expert. But for this, what I would say is, I always advise my clients, if I see, okay, you've got a credit card and you're at 90% utilization, I don't expect you necessarily overnight to just get it down below 30%. But I would set yourself some goals of saying, okay, I want to get it down to 50%. Now, because as you start to pay it down, you will see your credit score will improve. As long as you're making your payments on time, you start paying it down. So my advice is, set some benchmarks and goals for yourself and start paying it down to 50%, then to 30%. But the sweet spot, I mean, the true sweet spot of utilization is like 1%. That when your credit card reports to the bureau, they're reporting 1% utilization of that. So just that you're only using, like, you have $25 balance on it or what have you. Like, so that's the ultimate. But again, I've seen our clients' credit scores go up tremendously when they get below 30%. Like if someone was over 50% and now they're below 30%, their score will go up 40 points. I mean, like we'll see a boom. Like, so to me, the sweet spot is really setting goals for yourself to pay it down. But if you can get below 30%, all the way down to 1%, it's gold.
Yeah, and I would just add that under 30% is where you're going to get the biggest bang for your buck. You're going to see the biggest increase. The credit bureaus do score you holistically as well. So you may get some points from going from 30, like let's say you're at 25 to paying the whole thing off. But that's not going to be nearly as big of like a 30 to 50 point jump. And the other thing is that there's ambiguity when that's why I'm saying you're better to have it before we pull the credit report, because it is somewhat of a shot in the dark. If you're at, like, let's say a 610 and we see that you're at 90% utilization on something, it's like, okay, we'll pay this down and we have a model that tells us that it's going to do this, but you're at the mercy of the algorithm and what they score you at. So better to know that up front than to be disappointed when you pay off 30 or 60% of a credit card balance to get you there and then find out, oh, the score still didn't get you where you need to be, or the rescore.
Okay. Next question here. So can a spouse apply for a mortgage and not have, the other spouse on the loan? And then additionally, the spouse who's not on the loan, does their credit score have an impact on that loan at all, or is that not taken into consideration?
So yes, a spouse, you don't have to have your spouse on the loan, but that means we cannot use your spouse's income to qualify you for the loan. So yeah, all the time. And in fact, I mean, we recommend to our clients that, let's say you're both of the spouses have 800 plus credit scores, and if they have the income, if one of them has enough income to qualify for the purchase, we'll recommend to keep the other spouse off anyway, because there's no point in leveraging both on the loan. But to the short answer is yes, you don't need to have your spouse. It's called a non-borrowing spouse.
And they can still be on the title of the property, and they won't be on the loan. So if they have bad credit, but they're on the title of the property, it's not going to affect the loan approval. But like Caleb touched upon, if you want to use their income, then you need to add them, and then they are going to look at their credit.
Okay, great points there, you guys. Let's see. Next question. Tab Khan, you guys might recognize his name. That he said, "Hi, John and Caleb." He has a pretty detailed client question here, so I might have you all connect afterwards. But one portion of the question is he's curious if you write loans in the state of Texas.
Yes.
Okay, great. Wonderful. Tab, I'll have you all connect afterwards here, so you guys can all have a more detailed conversation on the other portion of your question there. But moving on to a few other questions. Generally, how low can a credit score be to secure a home loan?
Yeah, so this is a good question, and things have changed a bit, as folks are well aware. We had a pandemic, right? And when COVID hit, what happened was lending got a little tighter. There was more risk, and so basically what happened is that the expectations for credit scores went up. Like, you had to have a higher credit score to qualify. So right now, what I would say is this: if you have a 620 or higher, generally speaking, it's a qualifying score, and we can work with you. Okay. Now, we can go lower than 620
for an FHA loan. 620 for FHA, typically 680 for conventional.
Yeah, so I would say like 620 to 680 FHA, then 680 up could go conventional. However, sometimes 680 you may find that a FHA could be better for you as well. We would price it out for you. What makes the most sense. Yeah, so then to that though, below 620 would be FHA as well, and we have the ability to go as low as 560. However, it's very challenging. The rate is higher. You end up having to pay points. It's very costly, and there's other compensating factors that go into that. So when we pre-approve you, we look at your income, we look at your debts, we look at your credit score, and we look at your source of down payment, your assets. So those are compensating factors. And if you have great income, and if you've got a lot of money in the bank, like assets that you could pay for the house, and you don't have a high debt to income, not a ton of debt, but you have a low credit score, something bad happened and it's haunting you, there's a way to get it done. But if you have a 560 credit score and you don't have any down payments, and you have a lot of other debts as well, it's going to probably be a no-go. But so I would say 620 pretty smooth sailing. Anything below that is possible to 560, but again, a big possible with as long as you have other compensating factors that can help overcome that. Does that make sense, John?
Yeah, I would just say 620 is like Caleb said, but then when you get below 620, you get into the underwriter discretion. And I don't ever like being in underwriter discretion.
Okay, so kind of going back a little bit to earlier we were talking about different credit cards, you know, your store box cards, Kohl's, you know, clothing store credit cards and whatnot. Is it a good idea to cancel those prior to applying for a mortgage, or should they still maintain those credit cards with a lower balance, for example?
So I'll just say this: one, if you can avoid it, don't get those cards. Like those, when you're at the checkout and they're saying they're going to give you 10% off, and you apply for that card, like it's really not worth it. And because
I mean, it could be worth it. It's just you got to again make sure that you're going to have a payment in 30 months. Put a reminder in your phone. It's very easy to do those things and then leave. And then I've seen this multiple times in my career where 60 days later, they're like, oh my gosh, I was at Kohl's. I did open this and I didn't get a statement. And well, now your credit is got a huge hit because of this. So just make sure you really are ardently managing it.
Yeah, again though, I just caution you though, because it's just another, it's a really just a tactic. There's no free lunch. They're gonna give you a 10% deal because they're gonna make way more off of you, right? So like, just be cautious of it. But to your point, no, don't cancel. We don't. If you have a credit card that's open, keep it open, and you don't need to close it. Just just make the payments on time, minimum utilization. Like but I wouldn't recommend just closing a whole bunch of credit cards just because you don't want to use them anymore.
Yeah, unless there's like you're getting an annual fee or there's like a reason. But if it's just a card that's just there that's got a zero balance, and it doesn't hurt you to have it open.
An overall credit question for a married couple. If one spouse has poor credit and the other has, you know, better or great credit, does the poor credit impact the spouse's credit score that is better, or are those, you know, completely separate?
Yeah. So John, you go ahead, John.
Yeah, I was gonna say it could. Here's if there's two borrowers, they're always gonna go off the lower of the two. So if you have a 740 and your spouse has a 620, we're utilizing 620. And the way that you could get around that is if your spouse with the 740 makes enough money to substantiate the mortgage, then we'll say, okay, we're not going to utilize the spouse that has a 620. Oftentimes, though, you need both incomes. So yes, the answer is yes, it could, depending on whether or not they're on the loan.
Yeah, just to kind of piggyback on that. I mean, so just for everyone here, when we pull credit, we pull from all three credit bureaus, okay? And we don't go off the highest score or the lowest score. We go off your middle score. And if there's two borrowers on the loan, whether it's a spouse or not, if there's two borrowers on the loan, we're going to go off the lowest middle score of the two of you.
Yeah, and it does. If there's three borrowers, we're going out the lowest of the three. So, oh yeah, it's like whoever's the lowest could potentially make it worse for the people that are the highest.
And is there a good way to close a credit card without it negatively affecting your credit?
It doesn't negatively affect it. Like it's not like, oh, I close this account and your score is going to go down for it. But what it can do, and these are more like for jumbo loans or people with limited credit history. But like, let's just say that you're trying to get a loan and you've got a Kohl's card that you've had for 5 years, and then the other two trade lines you have, you just opened up. Well, 4 months prior, you closed the Kohl's card that had a 10-year history. Now it looks like, oh, all you have is these two credit cards for 6 months. So your score won't go down. But when you get underwritten for conventional loans and FHA loans by a computer, believe it or not, up front. So this computer there's really no rhyme or reason. It can just basically be like, oh, there's all we see now are these 2 6-month trade lines, and we don't like it. So the question is like, well, should you have kept that open? So it doesn't necessarily affect your credit, but at the same time, it doesn't hurt your credit to leave it open. So unless like there's a reason why you're closing it, like they're charging you an annual fee, or like there's really no reason to close it unless you just want to close it. But if you do, where it could have an effect is if you have a limited credit history. If you're somebody who has, you got a lot of credit, you're older, you're more established, you've got a couple mortgages, you want to close your close card, fine, do it, not a big deal. But if you're somebody just starting out and your credit's on like the borderline term, talk to us before you just go, talk to an expert before you just knee-jerk reaction, go close a bunch of stuff, so that we can advise you on how to do it and what to do.
Yeah, and it sounds like that can be kind of a case by case scenario.
Yeah.
So taking many different things into consideration before immediately closing anything. So, okay, let's see. Going back to large purchases, we talked about being mindful of taking out new lines of credit and whatnot. Is there something that constitutes as a large purchase, something that should be avoided? Is there a dollar amount or threshold that someone should remain under?
So when we say large purchase, like, so when I think this is like in reference, like I'm getting a loan, and do I make a large purchase while I'm in process or something like that? So typically, you just need to talk to us before you make any purchases. Our knee jerk is going to say don't make any purchases. However, if it's something you absolutely need, like someone, we've had a client who said, my car is broken down, we're not closing for 30 days, like I need my car for work, I need to get a car. Like, so then what we do is we look at your debt to income ratio and look at what would happen if you got a car and how would that impact your debt to income ratio. If it's not going to have a negative impact, again, consulting with us, we run the numbers, make sure, then you can do it. But if it's going to skew your debt to income ratio, and the debt to income ratio essentially is how much money do you bring in every month and how much are your minimum monthly liabilities going out every month? That's your debt to income ratio, right? So adding a car payment in there, well, that's more debts going out, so it could skew that. So as long as the numbers are fine, we would say you can do it. But again, our knee jerk is going to say no. Talk to us first before you do anything.
Okay.
Yeah, and I would say a large
making sure there's transparency.
Yeah, and I would say a large purchase, just to specifically answer the question, would be, furniture that's thousands of dollars, a car that's thousands of dollars, a motorcycle that's thousands of dollars would be considered a large purchase and can have a $100, $200, $300, $400 payment, which can, believe it or not, you're approved one day and then you go buy furniture and now you're not approved. So I've had clients in the past that had to go return furniture because they bought furniture right before closing. That's another thing we commonly see. Buy a car after you buy a home. Don't buy a car, then buy a home. We see a lot of people are like, oh yeah, I'm established, I went and bought a car, now I want to buy a home. And we're like, okay, well, you can't buy a home now because you bought this car. So always run it by us. And there is some irony in this, that we care about what you do up until the mortgage funds. Once the mortgage funds, you can go buy a car. We don't care all of a sudden because we can't go back and take the mortgage away from you.
And I think that kind of answers another question here in regards to making any large purchases even before starting the loan process. It sounds like still kind of maintaining those restrictions in terms of not making any large purchases prior to starting the loan process as well as during. Would you guys agree with that?
And we're a phone call away. Call us and we'll say, yes, you can do it, or no, you can't.
We'll look at your debt to income ratio. We'll tell you where you're at, and it depends on what you're trying to buy and all that. We'll do that for you.
And something to keep in mind though is like if we pull your credit report and you're pre-approved, your credit's good for 120 days. So if you go buy a car, they're going to basically verify the debt and verify, like Caleb said, that you can still pay. Your debt to income ratio is still within approvable limits. They're still going to use the score for 120 days that we pulled prior. But when you get new credit like that, it'll affect your credit. Your credit will go down for 3 to 6 months after you make a big purchase because it's a newly established account. You just got a mortgage. Over the long haul, it will help your credit, but in the short term, you will potentially see a drop in your score because you bought a car. So touch base with us just to make sure that we know what the ramifications could be.
Okay. And then real quickly here, I know we are closing things out.
Yeah.
Last question. If I purchased a home recently, but then my credit score has improved, is there a time frame that I could wait to then refinance for potentially a better rate?
I mean, we can look at you right now. So I recommend they reach out to us. We'll take a look at it, and we can see what's possible.
Yeah, technically there's no
waiting.
There's no waiting. So you could refinance the next day.
Okay.
No matter what, a lot of people tell you that you can't, but when you call us, we can tell you why, but that's not true. You can refinance as soon as the ink dries. Most of the time. 99% of the time.
Good. So those are all the questions that I have coming in here for you guys. Thank you so much for sharing here with everyone today about ways that we can improve our credit, and we appreciate your expertise.
Yeah, and again, we are 100% referral based. If you have anyone that is looking to buy that needs to get pre-approved, we're working for you to get your pre-approvals. And the same thing, or if you're looking to refinance, right now rates are still at historic lows, and we are refinancing folks quite a bit. So we're here to help you spread the word, and thanks for joining us today.
Thanks, guys. Have a great day.